Welcome back, and I'm very pleased to welcome you to the next session hosted by GSK Stockman. I'm very pleased to introduce to you our speakers, Marcus Peter, who is partner at GSK Stockman, Matthias Meckert, head of legal Continental Europe, PGIM Real Estate, and Laurent Ternisienm, who is chief executive officer, BNP Paribas Real Estate Investment Managers. I hope I got that right. I saw the abbreviation. I figured that would be the right one. So we saw in the previous panel, or heard in the previous panel, that which was about ESG data in private markets, we heard reference being made to real estate having already addressed ESG for some time now. So that's, I would say, some additional context, perhaps, for this panel, which is about providing practical experience pertaining to the implementation of SFDR requirements in the real estate sector. So, gentlemen, I invite you to the stage, and the floor is yours.
Okay. Thank you. So my name is Matthias Meckert. I'm the head of legal Continental Europe with PGIM Real Estate, and I show you a couple of slides, not to place some shameless advertisement, but just to show you a little bit the range of real estate investments you are facing if you talk about real estate and ESG. And we later on will talk about the challenges which are actually brought by that, because it's a rather diverse investment space, I have to say. First, I have to apologize. This is an all-male panel, something I don't like personally. So I did ask, usually when I get an invitation for a panel, I ask my female colleagues to come up. And I had two very competent female panelists, Julie Townsend, our ESG lead, and Christine Fritz, portfolio manager, senior portfolio manager of one of our core funds. Both are unable to join us, and they said, well, maybe then you go. And then, okay, I do it, but I have to say I'm standing on the shoulders of giants, female giants in this respect, because I've picked a couple of their slides as well. So just to make that clear, who's responsible for what one. So let's briefly talk a little bit about real estate. All those numbers you could ignore. Look right top side, net zero commitment, and I think this is rather now coming more and more common in the real estate industry, as well. PGIM Real Estate has made a net zero commitment by 2050. I guess this may change over time, but I think this is at least what we're aiming for the time being. And you see all the other numbers, trillions of whatever. Now we're talking about real estate. This is more to show you how diverse the spectrum is. We are a global investment manager, a rather large one, as you may imagine, and we are obviously focusing on a lot of different countries and jurisdictions, and they all have a different, as well, sometimes cultural approach to ESG, and they're well advanced or less advanced, and they have a different political climate, they have a different climate, and they have different challenges, and of course, ultimately different regulations. So for us in real estate, even if we're in a global organization, there's no such thing as a one-size-fits-all solution. And to make things even worse, the first slide was focusing on real estate equity investments. As an institution, we do have as well real estate equity loans, so debt investments, which again is providing slightly different angle to real estate because it's more indirect. Yeah? So we have less of an access. So in an equity investment, we own the property. We could technically, in most situations, switch off the lights, which is different if you're just providing a loan to somebody who's doing it. Fun fact, we do have an agricultural-based business since 140 years. So actually, we have a little bit of a tradition in really going into soil, and hopefully good soil in this respect. Briefly talking about ESG and what we're doing, and again, it's a little bit talking about standing on the shoulders of giants here. The real estate world, and as well PGIM Real Estate, had been focusing on ESG for many, many years. Actually, I had a claim on my desk, being a head of legal, that somebody claimed that we still did use a picture in a report, but we didn't have a license anymore, and did find out that we published that report on sustainability back in 2008. So the license was long expired, but somehow showed that even at that time, we did provide sustainability reports to the public. And obviously what we see now over the years is something which I would call an exponential growth of ESG in all our committees. If we talk with asset managers, portfolio managers, investment committees, it did grow over the years, and currently it's obviously all over the place and in many aspects the decision-making element. Briefly mentioned the net zero commitment, which, to be honest, if you think about real estate, could be potentially be a large challenge, and is for us as an industry a huge challenge, as well as a society, because there are a couple of very unknown elements here, factors, technology-wise, construction-wise, which need to be resolved to achieve that goal. We could talk later about the differences between industry standards and regulatory standards, and here we would like to show you a couple of examples about industry standards. So I think you may be all familiar with building certificates at different standards across the globe, but we have a lot of properties, 212 to be exact, which received building certificates of different standards, green building certificates. And there's another element in the fund industry, real estate fund industry, which is the GSK standard, where you get actually rated against peers, which is actually very interesting. So if in a year you do nothing, you're actually losing. Meaning because the whole industry is advancing on the ESG levels, you need to grow on the ESG front, otherwise, so to say, you're losing points. So it's a relative rating, which is very interesting compared to, for example, how SFDR is working. GSK, just for those who haven't heard about that, it has a mixture of factors consisting of, so to say, ESG performance, as well as, so to say, the management of properties and pieces of real estate. Couple of words about different real estate strategies, because each real estate strategy does require a different ESG strategy, and this is just a blunt example. Yeah, we have the debt world, we have the equity world, and in both areas we have, so to say, core plus, and value add. We don't have anything opportunistic, but somehow it shows, yeah, in a core asset in the real estate world is a stable asset, fully let, good place, usually rather up to date regarding technology. There's not much room to improve, whereas obviously on the value add front, you could actually refurbish, and there, so to say, ESG has a slightly different element to it. So core requires you to buy a good asset day one, as well from an ESG perspective. Value add, you could transition and manage to ESG, yeah. So, which means as well from a regulatory perspective, we need to have a different approach for all of those different strategies. Yeah. Again, this is numbers. This is the advertising part. And obviously, briefly talking, last slide, briefly talking about data gathering, which is the biggest exercise. And again, we've done that for other situations, tenant data, et cetera, So ESG is just another element, another data source, which we're actually pouring into that data lake, which we're currently managing. So thank you for that part. And we talk about ESG in a second.
Yeah, thank you, Matthias. So just to let you know that Matthias introduced a bit his business. Now Laurent will do the same. So you have also a good overview of what they do with you to ESG, but also with you to their overall real estate business. So we can also put them into the right category from experience. Yeah? So Laurent, please go ahead, and then we move into the discussions.
Thank you. Yes, just a few words of introduction for BNP Paribas REIM and what is really our ESG strategy and what we are doing related to SFDR. I should say I'm very pleased to be here and to have been invited to this event. We are, I think, one of the first real estate funds to have obtained the Lux Flag label. So very proud of that. And obviously, it's an important achievement for us. So in a few words, BNP Paribas REIM stands for Real Estate Investment Management, is within the BNP Paribas Group and its galaxy, the arm which is looking after investment management for real estate, and particularly one segment of real estate, which is the private equity side. So we don't do real estate debt, like was my colleague, and we are really a European player with more than 50 years of experience, and now 30 billion of assets under management, so which put us as one of the leading real estate investment managers within Europe. I mentioned the European range because I think that's important, because particularly for real estate and to implement any kind of ESG strategy, you need to be close to your asset in order to act. And this is why also we've got quite a lot of people on the ground. So with the 360 people we've got, they are located in 8 different offices. But what I wanted to show on this slide is the fact that so we are covering different type of investor and different kind of product. And particularly on one side, 1/3 of our activities is for private investors, and the rest is for institutional investors, half of it through funds, half of it through mandate. And I think, in fact, the reason why I mentioned that is because the ESG strategy is not exactly the same depending on the profile of investor you target. Obviously, when you are in a mandate, you depend on what your investors want you to achieve, because you are not in a discretionary position quite often. And at the opposite, when you are in the retail world, so for when you develop funds for private investors, there is a lot of interest for ESG topic, without any doubt, from this part of the segment, but still a lot to be done in terms of education. And you see a lot of survey in the space of private investors where there is a willingness to do, but in terms of act, it is still relatively slow at this stage. And that's interesting because I suspect that we were talking about regulation, and one of the regulation going on now is the MiFID I, which obviously will require or is requiring an ESG questionnaire to be filled by the investor, and I hope will accelerate the education of the population in this area. On the other graph, you see the kind of assets we are managing, and I think it's also interesting because we understand very well what you can do on an office building in a city in terms of climate impact, reduction of CO2 emission or so, but it's interesting to see that, in fact, real estate is not only offices. It's less than 50% of the stock is composed by offices, and more alternative asset classes are emerging, and we are following them. You mentioned agriculture. We've got a fund dedicated to campsite, for example, which is also an interesting asset class. And we need to develop ESG strategy for each of these asset classes, because obviously for us, ESG, as any ESG policy for us is developed at 3 levels. At the corporate level for BNP Paribas REIM, part of the BNP Paribas group, and we are helped by the fact that BNP is well advanced in this area, but also for each of our products, where we have to decide which is the strategy in terms of ESG we want to implement. And obviously, in fact, we own building at the end of the day, and for each of our building, we also need to decide what is the action plan, what we want to do, how do we want to position our assets. So that's quite an interesting exercise we are doing, keeping in mind that obviously ESG is one of the 5 pillars of our strategy for the next 5 years. So a very important component of the activities of everyone. The translation of our ESG objective is on this slide. Our goal, our mission is to have 90% of the product we have, so meaning funds, open to investors, with an ESG label attached to it before 2025. 90% of the funds Article 8 or Article 9 in the next 5 years. And I'm pleased to say that we are in advance to our roadmap, because we are already at 85% of our funds at the end of this year, which will be Article 8 or Article 9. So a very, very strong changes we made over the last 2 or 3 years to transform ourselves in an ESG real estate investment manager. The way we do that is obviously we look at the 3 elements, the E, the S, and the G. and the G. And the way we are doing it is that you've got these three categories, 6, 8, and 9. We have created an 8- or a 6+, just for ourselves, which is a category of funds that we will upgrade over the next years. So that's the way we operate, and each of the fund manager, each of the asset manager is working on it. I mentioned that because that's important. In fact, in real estate, as Matthias mentioned, we are controlling the underlying asset, and our job is really, we've got actions to take at any point of time, from the sourcing of the asset and the definition of the strategy of our product to the disposal of the asset and the end of the liquidation of the fund. And at each of these steps, we have defined what we can do, what we could do in terms of ESG, and who can act as well. Because obviously we've got an ESG team with strong people, but it's a small team, and their objective is not to do everything, but more to guide the rest of the business to do the right things. And this is why, in fact, our asset manager or fund manager, you see a lot of terminology, or investment manager or property manager are all involved in this ESG roadmap. I just want to conclude with two final slides. So we have been quite busy with the regulation. Sometimes it's a bit annoying because, in fact, the time we spent on filling report is not the time we spent on acting on ESG matter. So anyway, that's a different topic for discussion. Initially, it was SFDR. At the beginning of this year, it was taxonomy. And nowadays, we are working very hard on the implementation of MiFID II with the three classification, A, B, and C, that we need to establish before the end of the year. So we've got quite an heavy agenda on this. And I think, as a conclusion, what is important is, obviously, we are doing it for the good and with a purpose. But we are also convinced that it's not only a way to limit our risk, it's also a way to improve the performance of our product. And nowadays, you've got, and this is what you see on the right side of the small table on the right side, nowadays, in terms of real estate, we've got the proof that, in fact, when you are acting on the environmental, it's the environmental dimension here, you have an improvement of your rental income, you have a decrease of your vacancy rate, you have a decrease of your operating cost, you have a yield, meaning, in fact, the price of your asset, which is becoming higher, and finally, you also have, in some cases, the possibility to borrow money at a lower rate. So there is a real impact on the performance. I think that's important to keep in mind. And on the left graph, I've put this one because there is still a lot to be done within real estate. So we are right at the beginning of a long journey. Here you've got the energy performance certificate of the real estate stock in one market. And you see that if we want to be at the minimum standard by 2030, there are around 5% of the properties currently in Europe which are filling the bar. And even when you look at the properties which are at risk, because you know that on the top of the regulation I mentioned, you've got other one at local level where in some cases we will not be able to rent an asset with a bad EPC or we will not be able to sell an asset with a bad EPC. You see the black part, which still represents more than 50% of the stock. So a few more years in front of us to improve the stock of real estate.
Yeah, thank you, Laurent. Yeah, I think we all heard that would have been my first question, but I think it's answered already. Team perspective, but Laurent said he has a small team, which is probably very efficient to deal with all those topics with you to the ESG, SFDR matters, and soon also then MiFID here. And I think also Matthias said he has his team, the two ladies, and probably a few people more, so that's very good to hear. I think what would be interesting, at least for me, maybe for the audience here as well, is to hear about your asset class. I mean, we have the title Field Experience from Fund Managers. Today it's here mostly about real estate. What's so specific for the implementation of the SFDR framework with you to real estate funds or real estate investments? You gave some initial ideas already with your presentations. I mean, Matthias also has experience with the debt a little bit. Are there huge differences, and how is all of this dealt with also due to terminology? Huh? I think we have also some industry labels or standards. So what do you see here? How is it developing? I don't know, maybe Matthias starts. Laurent has a little break after he talked.
Happy to pick this up first. Yeah, I think the important part of real estate, or let's start with the regulation first. And the regulator, and have a lot of sympathy for the regulator here, intended to look into the financial markets, financial products. And obviously the market is dominated by bond products, it's dominated by securities, and then you have the small part which is alternatives. And within alternatives you have private equity, infrastructure, and then us, the real estate guys. So actually, they try to implement, which is something like a one-size-fits-all solution, and obviously they came a little bit to their limits when they thought about real estate, to be honest. So a couple of things which do work very well for bonds and securities do not work for real estate for various reasons. And maybe we give one example, and Article 9 has been mentioned by the guys before us. I think the big challenge for real estate in Article 9 is currently that it's been perceived, and I think this is a market perception by all advisors and the regulator, that in an Article 9 fund, all of the assets, day one, need to be sustainable as defined in the taxonomy. And this is very difficult for an impact fund in the real estate world, because we consider impact on real estate that we buy, so to say, a bad asset from an ESG perspective and improve it over time to a higher ESG level to make it really sustainable. And obviously this idea which we had in mind when we had been discussing in Europe, but as well globally, whether we are able to launch an Article 9 fund with this idea of impact and manage to ESG, this doesn't really match, so to say, the regulatory requirements. So we may do something like that, but we are not able to use, so to say, the Article 9 definitions. Yeah? We may need to go back to something, this is an Article 8, but between you and me, it has an impact and should make an impact on ESG. So this is a little bit the trouble we're having. I don't really blame the regulator for that one, to be honest. It works very well for bonds and securities. You buy a good asset day one, you keep it, and if it's no longer compliant, you sell it. Yeah, this is just easier to trade compared to real estate, where we talk much more about transition. And you mentioned a couple of things about upgrading portfolios, et cetera, The whole transitioning process is for real estate really the driver. Not really yet reflected in the regulation, but we see it's reflected in the industry standard. And I think this is one of the biggest differences between industry standards and the regulation. They look much deeper and they're much more real estate specific. Green building certificates as well, GRESB and a couple of other standards, they're obviously designed for real estate and not for all kind of financial products.
Yes, I think it's what makes our industry, in fact, slightly different from the rest of the others. We are in control of the underlying assets. So when in bond and equities, you work on the sourcing. So before you buy any asset, you can exercise your voting right, and then you decide when you sell. On real estate, any decision we take could have an impact. So when we select a new tenant, on the top of the previous one, obviously, when you select a new tenant, we can have an ESG impact depending on who we'll select. When you engage some work in the building. So everything we do could have an impact. So that's what makes us different, and what I think, as you said, with the sort of one-size-fits-all rules we've got currently, is difficult to adapt concretely to real estate. The way we have managed that is that we have developed two kinds of strategies. One which is a sort of best-in-class one for some of our products. So, in fact, we will buy assets and we will keep the asset at the best level possible in terms of ESG matter. EPCA or building certificate at a certain stage. And we've got another strategy, which I found the most interesting one, because it's the one that really has an impact, which is the best in progress, where we buy assets that we know we can improve. And I think this is probably the future, and perhaps the few adaptations which will be required in order to take into account the specificities of our industry.
So one question for me, because you have investment funds, so real estate investment funds. If they want to become 8 or 9 funds and the real estate is not really up to date with you to the requirements, then the fund seems to have a need to invest more into those real estate properties to, I don't know, change the windows or the heating system and so forth. Is this causing problems, or are you probably assessing one real estate property by the other to see what has to be done? Or are you shifting around real estate properties to make one fund 9 or 8? How you deal with this? It's probably not easy.
Well, on Article 9, I think that's you need to be compliant or not. So it's rather binary, I have to say. You're sustainable under the taxonomy or not. On Article 8, I think another element which I like about the SFDR regulation is the flexibility around how you define your ESG-related binding investment criteria. And there, I think it was a very good approach by the regulator to say, we don't give you more guidance. I think many market participants complained about that and was saying, oh, what do we need to do regarding Article 8? And there was a lot of uncertainty in the market. But actually, it allowed us as a manager to do something which we think is the right thing to do, and which, so to say, fits our asset class. Even within the real estate industry, yeah, many players have different solutions for that one, and our solution maybe look different to BNP Paribas and others in the market, and we know that. Yeah, we're obviously looking around who's doing what. So there are very different solutions. I think over time, things will sort out in a certain way, and there will be more market standards to establish, but they are market standards and not, so to say, imposed by regulators. So I think this is the element I like very much about Article 8. To your question, how to upgrade, I think it's less a regulation which is asking us to upgrade. It is more really the fact of the stranded asset risks. Yeah, that at a certain moment in time, we think that our assets, which may be very old and have a very bad energy performance, et cetera, basically are no longer marketable in the market. Yeah, and this is driving us to improve the assets. It's less directed regulation. The sustainability risks management tools, which we are sort of now asked to include in our risk management under SFDR, are actually forcing us to look into that. But to be honest, we considered those before as just a pure financial risk. And ultimately, a sustainability risk is a financial risk. Yeah? If you're not improving your asset over the next years, at a certain moment in time, there's a risk to become a stranded asset. And this will be a financial loss, of course. Yeah.
Mm-hmm. Okay.
I think also the other driver behind all of this is the investors' demand. And particularly, again, on the institutional side, we have seen a shift over the last 3 years of investors who have gained in terms of sophistication on ESG matter. And some investors, and there are more and more, won't invest any longer into an Article 6 fund, or they will invest only on Article 8 and Article 9. To come back to your point on how are we able to transform, I think it depends on the nature of product. PGIM, I think you've got a lot of closed-ended funds, so in fact you just need to wait for the next vintage to develop the new strategy. On open-ended fund, it could be more challenging to do such a thing. Clearly, Article 9 fund, and we've got 2 of them, they have been built as an Article 9 to make sure that they've got an impact. One is focusing on climate change. The other one is focusing on social impact, which is even less advanced in terms of regulation, by the way. Perhaps we'll come back to that. And this fund, you can't transform them. They have been set up like that. Article 8, that's possible to have a fund which was not an ESG fund, and to adapt it by buying, selling, defining action plan on your existing asset to transform it into an Article 8 fund.
Yeah, I think that's also what I've seen. It's difficult to make a fund into Article 9. Yeah, so this is really something which is tough and also would be expensive. So the Article 9 funds I've seen in our practice are mostly funds which have been set up newly, and they will invest from the beginning into Article 9 products, also to be fully compliant. You mentioned briefly the investors, Laurent, I think institutional investors. Well, what do you see with you to due diligence towards you? So the investors making due diligence towards you and your funds. You know, I imagined, or I've seen at least also questionnaires which are much longer now, asking many more questions. And then also the second step, due diligence downwards into the asset which you want to acquire. You probably also have worked out a bit more complicated questionnaires to ask the right questions to the below asset managers. So.
Yes, that's correct. And I'm a bit worried because our ESG team now is spending more time to fill questionnaire and to fill reporting for regulation than to really think about ESG matters. This is what I've said earlier. And again, on the sophistication of the questionnaire, there are more and more questions, more and more detailed questions. So it's a real challenge to be in a position to have all the information requested by the investors. But we are all learning at the end of the day, and I hope that standardization will help as well to make sure that, in fact, our life is becoming a little bit easier.
As we are focusing on institutional investors, at least in Europe, we could have more a discussion between grown-ups. And we had very intense discussion with numerous investors about what do they expect from an ESG product, what we think are able to deliver in an ESG world. And it's a common learning curve, yeah, for all participants around the table. But obviously we see more getting more intelligent questions, more detailed questions. We try to move, so to say, a little bit to standardize as well the answers in a world that we say, well, look at our GRESB rating, for example, which I think in most situations actually answers a lot of the questions which most investors are actually asking us, to get away from, so to say, individual questionnaires, which is time consuming and sometimes not really leading into the right direction. But the feedback I generally get from the ESG teams these days, it's, oh, it would be great if we could focus more on doing the right thing and not less reporting about it. In particular, so to say, now the current deadlines which we're approaching regarding SFDR disclosures, now with principal adverse impact and taxonomy over the next months and next year, obviously this is a data gathering exercise. It's a huge data gathering exercise. Some of the data points, we didn't have them on file before because other regulations are looking into other things. Though that's currently a big topic for everybody who's focusing on ESG, and it really drills down to property managers, asset managers, portfolio managers, ESG teams across the globe. It's a little bit, as they say, it's a little bit distracting. They would like to focus on other things and improving the ESG situation of each asset and less of the data gathering. But it is as it is. Yeah, I think we will complete our exercise here. We'll be obviously then fully compliant when the dates are coming. But we would like to do more the right things, I have to say.
And perhaps one thing to be added to ease the market to understand what we are doing is on the top of the regulation, I think the certificate and label are a very interesting tool. In real estate, they have started at the building level, and you mentioned all the different certificates which exist at the building level during its development phase and when they are in use, the BREEAM, the DGNB, and others. There are perhaps too many of them in a way, but that's another story. And I think we start to see also more and more on the real estate side label and certificate at fund level. So Lux Flag is a very good example. But this certificate, they have to be adapted to the real estate context. We can't only replicate what has been done on the other asset classes, like what we have said before, on real estate fund. And so what we have done, for example, on our side, is particularly for funds which are dedicated to private investors. All of our funds have the ISR label because it's the most well-known in the French market. And more, even on the institutional side, we have selected the Lux Flag label. It helps to prove to the investors what we are doing.
So would you say that the labels also help to facilitate the due diligence, make it a bit easier? Because, I mean, I think it takes already more time, maybe a bit of delay when the people have to fill in the longer questionnaires and there's more back and forth between the institutional investor and also you as the manager. But I think the labels might help to accelerate the process a little bit. Huh?
Yes, and it creates the trust as well. Huh? So, you know, they are more confident when they see that we have achieved the label because it has been checked by someone else already.
And most of the labels have been around for decades actually now these days, yeah. So there is an established trust relationship. People know what they're getting, yeah, and they know how to. Even so, there are different labels on the building certificates level, yeah. People know how to compare the different labels globally, yeah. So we're talking with institutional investors, and they know what the difference is between a LEED label or a DNGB or a BREEAM in use label. Yeah, so I think that's very well advanced. Whereas obviously, currently the current regulation is focusing very much on energy performance certificates, as you know, and it's something everybody needs to report more and more. Whereas obviously, but when we started doing the data gathering exercise on EPCs, we did find out that even so it's a European regulation, there are a lot of national nuances. So we're currently scratching a little bit our head how to put them in one reporting sheet, which the disclosure regulation is asking us to do. So we're currently filling the gap in a very transparent way. So part of our disclosures is that we are explaining how we did it. Yeah. So the annexes actually are very short, as you may have seen. Yeah. So what needs to be filled out on SFDR, but as well on the taxonomy side. It sometimes reminded me of this idea to have this green, red, yellow items on the refrigerator. Yeah. To make life easier. It may make sense, so to say, to be very simplistic for retail investors. For institutional investors, actually, they try to look through. They look through definitely all the way. Yeah, they ask much more questions. They would like to understand the composition of the portfolio in its details. They look into, yeah, they would like to understand each rating for each individual property. Just maybe give you one example what maybe one result of the taxonomy regulation nowadays. So the taxonomy regulation actually ultimately is very binary. Either your property or on the property level, it's either a sustainable investment or not. And it doesn't differentiate between different shades of green, so to say. And this makes actually the evaluation of a fund and the due diligence of a fund actually more difficult, because a fund consisting of 10 assets, 2 are A and B, which are then considered potentially sustainable, and the rest is a G, looks like the same, where you have 2 which are A and B, and the rest is C. Obviously, in the fund composition in total, it makes a lot of a difference, yeah. But so to say, regulation is only, you're either in or out. How much out you are, yeah, they don't care in this respect. So there may be some, I have to say, misleading results of taxonomy. And I guess over the course of the next years, the regulator together with the industry will clean those things up. But we first need to see really the first results. And this is something actually for next year.
And yes, and I fully agree with you on the EPC side, which is now becoming the key for the real estate industry. When all of us were aware, at least in the real estate industry, 10 years ago we were using EPC, and we discovered that in fact they were not consistent. It was extremely difficult to have harmonization and so on. So we decided to move away from EPC to certificate and to these kind of things. And now we are back to the EPC world, and it's a bit annoying because you are correct. From one market to the other, it's completely different. I take an example, the office stock in Amsterdam. There are, I think, 60% of the office stock which is already classified as A. Honestly, if you look at an office block in Amsterdam, it's not much more efficient than an office block in Luxembourg or in London. It's just that the definitions are not exactly the same. So it doesn't help for the time being, but I'm sure that we will find a way to improve consistency over time.
But that doesn't mean the label is somehow wrong, yeah, or certificate.
No, it means that in fact there is a lot to be done in terms of harmonization.
Mm-hmm. Yeah. Yeah, I mean, if you look at this whole ESG SFDR framework, it's not so old yet. Huh? I think it will happen in the next 1 or 2 years. There will be more refinement. Also, the regulators will have a chance to look into this a bit better. I think Matthias said that was BaFin probably who gives more flexibility on Article 8. Here from the CSF, we have a bit more guidance already, but still also flexible. But this will come in the next 1 or 2 years to have more harmonization. We need this as well. Otherwise, you cannot compare the fund products with each other in the right way. Yeah, very good. Yeah, I think we are at the end of our discussions, but we still have to be seated, I think, a bit longer. Remain here for questions. No, Denise, yes.
Thank you so much, gentlemen. We could have continued forever, I think, gone a lot time longer. Are there any questions? I do have one. There's one there. Thank you.
Hello, thank you very much. My name is Laurent Kops, investment manager. So real estate is quite still, I would say, in transparent and illiquid market. First question here is, does this lead to more risk of higher greenwashing in the market? Second question is more on real estate development projects. Imagine you have a field, you decide to build on that field. For this, you need a permit that the state will only give you if you already comply with some energy efficiency considerations. Does this mean that by nature, this development project would be some way ESG compliant or Article 8 compliant?
If I start with a few comments on the lack of transparency and illiquidity, I think you are partially right, but not really, because at the opposite. So I think in terms of transparency, our world has evolved quite considerably, and there is much more transparency in the real estate market today than even 5 years ago in terms of information and data available. Liquidity, yes, it will remain for at least for a long time. The real estate market, it's not easy to make a transaction, so it will take time to buy a building and to sell a building. So there will still be some illiquidity, but I'm not sure that it has an impact on greenwashing in any case. At the opposite, I think that there is a very strong advantage to our industry, to our asset class, which is the fact that because we again, in fact, we know what's going on in our building. We've got much more detailed information than the other asset classes. So I will think the opposite. There is less chance of greenwashing in real estate than in other asset classes.
Yeah, I could echo that. So if you buy a security stock of a big company, sometimes you don't know what you're getting. Yeah. Whereas on a piece of real estate, it's rather small comparatively and easy to evaluate from an ESG perspective. Yes, of course, yeah. If you go through a building certificate process, you may be asked 300 questions or something like that, but ultimately you know what you're getting. Yeah, we have, as an equity investor, full control. Whereas if you buy a share in, and I think these are the controversial parts, yeah, where you buy a share in Shell or something like that, where parts of it is actually doing good things, part of it is doing bad things. How do you validate that? So I think this is much more intransparent as our small real estate world, I have to say.
And on the second question, which I don't fully remember.
Yeah, that was about the field where nothing is built yet. And you want to invest in the green field. Yeah.
That's the difference in between my two strategies, the best in class and the best in progress. So obviously, when you buy a new building, yes, it will be a green building as of today. But you shouldn't forget one thing, the fact that, in fact, first, real estate represents 30% of the gas emissions, the CO2 gas emission altogether. And on this 30%, in fact, half of it is linked with the construction and the other half with the management of the building. So I'm not so convinced that by building, and I'm not sure I should say that because I also belong to a group where we've got a property developer, but you need to be careful. In fact, during the construction phase, you will, if you are not careful, not be very efficient in terms of CO2 emission.
Yeah, and I could echo that as well. So the biggest issue in the industry is heating, of course. Yeah, I think, but this is pretty obvious. And the other one is concrete. Yeah, concrete is just an ESG nightmare. We all know that by now. And I think there are a lot of unresolved technical questions these days. Yeah, there will be changes. I think that's definitely clear. And so to say, last word and sum it up a little bit. We're taking stock where we currently are, yeah, and described a little bit the status quo as of today, and even tomorrow, I think things may change. Yeah, so we will see a lot of changes in regulations. I think hopefully we don't see much of national gold plating and additional regulations, because this is just making our life very difficult as a global manager. And we need a lot of technology changes there as well. So this is very much about engineering now, what we're talking about, to make buildings energy efficient. There are a lot of challenges, to be honest. Yeah.
Thank you, gentlemen. It sounds like lots of opportunities for investment as well to resolve those technical issues. So thank you, gentlemen, very much. A really great session, and I appreciate it.
Yeah. Thank you.
Thank you. Thank you. Okay, well, next up at 5 o'clock is a session with Société Générale Private Bank on corporate social responsibility. Thank you very much.
Merci de vous avoir rejoint. Je suis enchantée.
Je suis ravi aussi
voilà, parce que c'est vrai que c'était quand même... voilà.
Oui, c'était un peu last minute.
Voilà.
Un peu last minute.
Chapeau, hein, parce que c'est vrai que c'était quand même...
Non, mais c'est bien. Oui, non, mais c'est bien. Après, on est ça.